Howdy, everybody. Welcome to Liberty Call. Today is Friday, December 6th, 2024. Hope you're having a fantastical day out there in the interwebs. Another beautiful day here in Colorado. Skies are clear. It's not too hot. It's not too cold. You can go outside, play some ball. Where's my man Jake at? Oh, he's under the desk. So we're going to go play some ball time, and then I got to head to the airport, pick up the missus, and because she spent the week on a cruise enjoying herself. Away from me, probably a vacation. It's probably a pretty good vacation anyway. So anyways, all right. Well, before we jump into the numbers, if you could do me a favor, give me some thumbs up, a like, share, subscribe, a follow, and press the notification bell. All right. Well, let's hop into the markets. Dow Jones was down 0.28% today, 123 points, closed at 44,642. S&P 500 up 0.25%, 15 points, closed at 60.90. NASDAQ up 0.78%, 154 points, closed at 19,855. So today the blue chips were down. The tech and growth stocks were decently up, and the porridge in the middle, the S&P 500, the broad market was right there in between. All right, VIX fell 5.69% today. It's at 1277. Canada up 0.05, so it's flat. Brazil down 1.48%, and Mexico down 0.82. Headed to Europe, Germany was up 0.13%, the UK down 0.49%, France up 1.31%, Netherlands down 0.31%, Spain down 0.39%, Italy up 0.36%, Switzerland down 0.14%, and Portugal down 1.18%. Russian exchange is both green again today. The MOEX up 1.05%. The RTSI up 5.08%. That's a pretty big jump. And the Asian markets, the Nikkei was down 0.8%. Australia down 0.64%. New Zealand down 0.69%. In China, the Shanghai was up 1.05%. Shenzhen Component up 1.47%. China A50 up 1.34%. DJ Shanghai up 1.14%. Hang Seng up 1.56%. And the Taiwan weighted when it closed on the 5th was up 0.05%. Alrighty, let's bring up our chart and see how the week went. Let's go to the 1 week. Alrighty, well, let's start out with the Dow Jones. Let's get that candlestick from the last week, and we're going to finish the week down 0.96%. The S&P 500, it's going to be up 0.9%, and the NASDAQ going to be up 3.31%. So again, for the week, kind of similar to today's market, the Dow was down just less than 1%. The S&P, the middle porridge in the middle, up just under 1%, and then the growth, the NASDAQ, which is heavily tech and growth stocks, up around 3%. So pretty good week, all in all. I mean, considering that the world's a mess. But anyways. All right, well, let's get to the economic data for the week. Initial jobless claims came in at 224,000. Forecast was 215, and that was the previous week's number. Continuing claims came in at 1.871 million. Forecast was 1.91 million. Previous number was 1.896. The ISM Manufacturing Purchasing Managers Index came in at 48.4. Forecast was 47.7, and the previous number was 46.5. So a little bit of an improvement there. Construction spending grew at 0.4%. Forecast was 0.2. Last month's number was 0.1. And total vehicle sales came in at 16.5 million. Forecast was 16 even. Previous number 16.2. The ADP non-farm employment change came in at 146,000, under the 166,000 forecast. Previous number was 184. All right. Factory orders grew by 0.2%. The forecast was 0.3. Previous month's number was a contraction of 0.2, so some slight improvement there. U.S. trade balance contracted to negative 73.8 billion. Forecast was negative 75.7 billion, and the previous number was 83.8. So a bit of an improvement there. And the non-farm payrolls came in at 227,000 in today's report. Forecast was 202. Previous was 36,000 last month. And the U.S. unemployment rate came in at 4.2%, right on forecast. Previous number was 4.1. The real unemployment rate, the U6 number, is 7.8%. Previous was 7.7, so it ticked up another tenth of a percent. And if we go out to the max, we can see, the U6 right going into 2020 was around 7-ish, so it's about 10% higher than where we were before all the COVID nonsense started. And we're better than where we were before Black Jesus became president, and then it really spiked. It was up around 17, and it took a long time to get back down during his administration. So anyways, all right, the U.S. labor participation rate is holding at 62.5. Forecast was 62.7. Previous number was 62.6. And last bit of data, the Michigan consumer sentiment came in at 74. Forecast was 73.1. Previous number 71.8. All right, so that is all the news fit to be, or all the data fit to be told for Friday, December 6th. All right, well, let's jump into the market recap. SP 500 briefly topped 6,100 as strong jobs report fails to dim rate cut bets. Everybody wants free money. The SP 500 briefly surpassed the 6,100 mark for the first time on Friday, driven by stronger than expected November jobs report and positive corporate earnings. Investor optimism remained intact with expectations for a December rate cut unchanged despite mixed labor market data. So the labor market insights, non-farm payrolls, jobs increased by 227,000 in November, surpassing expectation of 202, while and recovering from October's revised gain of 36,000, which was impacted by hurricanes and a Boeing factory strike. A household survey, weakness emerged in household employment, which declined by 355,000. Following a 368,000 drop in October, the unemployment rate rose slightly on an unrounded basis from 4.14 to 4.25, although it met expectations at 4.2%. Earnings growth. Our average hourly earnings rose 0.4%, beating the 0.3% estimate and suggesting ongoing labor market resilience. The Fed's outlook. The data supports a 25 basis point rate cut at the Federal Reserve's meeting December 18th. Corporate earnings highlights. Ulta Beauty rose 10% after raising its annual profit forecast, driven by strong holiday demand for perfumes and makeup. Yeah, ladies, make yourself pretty and smell good. You might find a man. All right, Lululemon Athletica surged 18% after increasing full-year forecasts, supported by robust U.S. holiday demand and international growth. GitLab gained 4%, better than expected Q3 results, and an announcement of a new CEO. And DocuSign soared 27% after raising its 2025 revenue forecast and posting strong Q3 results. Despite some labor market weakness, robust payroll growth and corporate earnings bolstered market sentiment. Investors remain focused on the Federal Reserve's upcoming decision and strong holiday season earnings, which are shaping the near-term economic and market outlook. All right, so they seem pretty giddy today. All right, let's get to some data. November employment report from First Trust. Mr. Robert Stein put this together. The U.S. labor market saw a sharp rebound in November, with non-farm payrolls increasing by 227,000 and a revision to prior months adding 56,000 jobs. Private sector hours worked grew by 0.4% for the month and 1% year over year, reflecting solid growth. However, the broader trend points to slower labor market expansion. Some key labor market insights. Weather-adjusted growth, averaging October and November, payroll growth reached 132,000 jobs per month, well below the 190,000 monthly trend over the past year. Civilian employment, which includes small business startups, declined by 355,000 in November and is down 60,000 monthly over the past year, suggesting payroll data may overestimate job growth. No, our government would never lie to us. Unemployment and participation. The unemployment rate rose to 4.2%, partly due to a drop in the labor force participation rate, which fell to 62.5%. Sector-specific data, core job growth, excluding government, education, health, and leisure hospitality, rose by 62,000 in November. Insufficient to offset October's decline, the core sector trend remains weak after averaging the 2 months together. Wage growth, average hourly earnings increased by 0.4% in November and 4% year over year, outpacing inflation and boosting real purchasing power. Yeah. And the Federal Reserve's outlook, despite the rebound, the slowing labor market trends support the Federal Reserve's cautious approach to monetary easing. The Fed is likely to implement a 25 basis point rate cut on December 18th, but may pause cuts in January, given lingering inflation concerns. Markets will closely monitor future data to gauge the Fed's next steps. Bottom line, November's rebound highlights resilience, but underscores a slowing labor market wage growth and, slowing labor market. Wage growth and hours worked provide a silver lining, but broader economic momentum appears to be cooling. The chime was the FedEx guy. I think he's delivering the last piece of my new KitchenAid mixer. Very excited. I am the cook and the baker in the house, so anything that involves the kitchen, I'm in charge of that just because A, I like cooking, and B, my wife doesn't. So it's worked out pretty well over the last 3 decades where, I usually made dinner and, she makes me happy. So, all right. Last up, got an article here from Zero Hedge, the commercial mortgage crisis deepens. So, if you've heard, if you've been paying attention or you're, someone who regularly watches, you're one of the 3 people who watches on a daily basis. I've talked a lot about commercial real estate going back to 2020 where, all the lockdowns and, people working remotely. Commercial real estate was something I suggested, just to, back of the napkin kind of advice. You probably want to steer clear of, the commercial real estate space because A, not as many people are working in offices, and B, these companies typically are pretty cash poor and they live hand to mouth. So they usually have to borrow money to, make their operational expenses work. And when interest rates go up, they have to pay more. So it cuts more into their bottom lines. And if they've got leases already locked in, there's not a whole lot they can do. All right. The U.S. commercial real estate market, the CRE, particularly office properties, faces momentum challenges as delinquencies on commercial mortgage-backed securities, CMBS, tied to offices hit 10.4% in November. Wow. This approaches the 2008 financial crisis peak and reflects a record 2-year rise of 8.8 percentage points since late 2022. So the key drivers of this crisis, malinvestment and credit expansion, near zero interest rates during the 2020 to 2022 led to speculative underwriting of loans, often with minimal debt service coverage ratios. Rising rates have since exposed these assumptions. If I could jump in here before I get to the other 2 things. We also had interest rates held at zero from the mortgage crisis back in 2008-9 all the way through the Obama administration. So do you think some of these companies got into some really bad habits of having, basically free credit that they were, they could borrow. They had to pay some interest, but it was, very minimal. And, do you think these people got into bad habits of living hand to mouth and, betting on next month's, payroll or receivables to, cover, next month's expenses? Yeah, that's probably what's happened. All right. Next up is zoning restrictions. Regulatory barriers have hampered efforts to repurpose obsolete office buildings, particularly into residential units. And remote work, accelerated by the pandemic, reduced demand for traditional office spaces has driven persistent high vacancies and plummeting property values, with some buildings losing 50 to 70% of their market value. We moved here we moved in this house in late June of 17, and this has been my office. I do lease space from Regis, which is huge. That it's kind of their market for small businesses and entrepreneurs, people who don't need a lot of space. Been using them for, 15 years now, seems like. And now all they do is collect my mail. If I need to book a conference room, I can go online and book one here, at where I get my mail, or I can, when I go to Houston for meetings, go onto the app, boop, book a meeting or book a meeting room for a few hours, and it's pretty cheap actually. It's a nice benefit to have. All right, but again, if people can get the same amount of productivity or more from people sitting in their homes, in their home office. And all you got to do is provide them with some technology to do it, a laptop or whatever. I have a nice tower here on my desk, so because laptops break too easily. But Anyways, all right, let's jump back into the fun and finish this up. Market impact. Office properties are the most distressed segment, far surpassing delinquency rates in lodging, 6.9, and retail, 6.6, and multifamily housing, 4.2. Commercial real estate and CLO bonds, particularly tied to those tied to office and multifamily properties, are seeing record distress rates driven by rising financial costs and underperforming properties. Now, I mean, imagine how pissed you would be if, let's say the property gets foreclosed on and you live there and say you get locked out. It's like, hey, this is my apartment or condo or my office. It's like I paid my rent, All right. So the broader implications, while financial risks are dispersed among commercial mortgage-backed securities and commercial real estate loans, investors, smaller banks with concentrated portfolios remain vulnerable. Investors hope for Federal Reserve rate cuts. See, that's why big business wants rate cuts. But the current rate of 4.5 to 4.75 and persistently high Treasury yields limit refinancing relief. Yeah, and inflation hasn't gone down. This structural crisis, rooted in overbuilding, regulatory barriers, and permanent work shifts, signals enduring challenges. Market sentiment, guided by monetary policy and macroeconomic conditions, underscores the fragility of the commercial real estate sector and its broader economic implications. All righty. Well, that's everything that I had to cover for today. If anyone needs to reach me about getting their financial plan back on track, go to DSAFinancialGroup.com. All your financial planning needs can be addressed there, so give me a buzz. I'd be happy to help you get back on track. All right, well, it's the weekend, and I hope everyone has a good 2 days off, and I hope the weather's nice wherever you're at. I think it's going to be pretty nice here tomorrow and part of Sunday, and the wife and I have some plans on Sunday afternoon, so we're going to go have some fun, and I hope you do too. So hope everyone has a great weekend, and I'll talk to you next time. Adios.